36 hours. That is how long it took for a quiet pricing gap between East and West to turn into something that traders on both sides of the world are now watching very closely. Because silver in Shanghai is not trading where silver in New York is trading, and the difference is not small. We are talking about a spread that, if it holds, starts to change behavior, not just price, and that is the part most people are missing right now. Last week, I told you to watch whether COMEX delivery pressure would actually show up in the March contract as we move toward expiry, specifically whether delivery notices would come in above the recent average and start putting visible pressure on registered inventories, and that is exactly what we saw as the exchange data rolled. Over the past few sessions, with higher than normal delivery activity showing up right into the close of the contract, which tells you this was not just speculative positioning rolling forward, this was real demand for metal. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos, and I have sat in rooms where these delivery decisions get made. I have watched what happens when the physical side starts to pull against the paper side, and that is why I am here, because retail investors deserve to see this part of the picture clearly. Everything I show you today comes from publicly available sources, and I will name every one as we go so you know exactly where it is coming from, because today we are going to walk through three things that actually matter. What this Shanghai premium really means beyond the headline, what the COMEX data is quietly signaling underneath the surface, and how to think about this without getting pulled into either the everything is breaking narrative or the nothing matters narrative. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now because it tells me to keep making these, and if you are not subscribed yet, now is the time because this is part of a bigger picture we are building week by week. Right now, silver is sitting in the low 70 seconds on COMEX, call it around $73, and if you have been holding silver for the past few weeks, you felt that move up from the high 60 seconds into the low 70 seconds. But here is the part that stopped me when I pulled up the Shanghai Gold Exchange data. Silver there is trading at roughly $76.85 on a USD equivalent basis, and that gap, roughly 5.3%, is not just a number on a screen. It is a signal about where physical demand is showing up relative to where futures pricing is clearing. Now, the central question for this video is simple. Does that gap actually matter for someone sitting at home holding silver, or is this one of those market quirks that looks dramatic but resolves quietly? And more importantly, what does it tell us about what happens next when liquidity returns and these two pricing systems have to reconcile? Before we go further, quick question for you, drop it in the comments. Are you seeing any difference in premiums at your local dealer right now, or has it stayed flat where you are? Because that real-world feedback matters more than most people realize. So let's start with what most people are saying, which is that a premium in Shanghai automatically means there is a shortage globally, and this is where it gets more complicated, because a premium is not just about scarcity, it is also about structure. The Shanghai Gold Exchange operates under a different set of rules than COMEX, different financing costs, different tax treatments, different delivery mechanisms, and that can create persistent price differences even when metal is moving normally. But here is what changed this week: the size of the premium and the timing of it alongside rising delivery activity on COMEX. When I looked at the exchange data and matched it against recent delivery flows, what stood out was not just the premium itself, it was the incentive it creates. Think of it like this. If you own a product that is selling for $73 in one city and $76.85 in another, and the cost to move it between those cities is less than the difference, you are going to move that product. That is arbitrage, and in metals markets, that arbitrage often shows up through delivery. So when institutions stand for delivery on COMEX, what they are effectively doing is saying, I want the physical metal, not just the contract, and if there is a higher price elsewhere, that metal has somewhere to go. Now here is the data point that matters. The CME warehouse reports this week showed continued pressure on registered inventories as we moved through the March delivery window. And while the total numbers are still within historical ranges, the direction is what matters, because inventory does not have to hit zero to create stress. It just has to tighten enough that participants start adjusting behavior. This is where the analogy helps. Think of COMEX inventories like seats on a flight. The plane does not have to be completely full for ticket prices to rise. It just has to be close enough to full that the airline starts adjusting availability. That is what tightening inventory does. It changes incentives before it creates a crisis. So what does that mean for someone holding silver at home? Honestly, in the short term, probably nothing dramatic changes this week, and that is important to say because markets can stay in this kind of tension longer than people expect. But it does mean you are seeing a divergence between paper pricing and physical demand signals, and that is something worth tracking, not reacting too emotionally. Now at this point I want to stop for a second and show you something that actually supports the other side of the argument, because this is where a lot of channels lose credibility. They only show you the bullish case. The bearish argument here is not crazy. If you look at the dollar index, the DXY has been stabilizing after a recent dip, and when I check the latest positioning data and macro signals, there is a clear case that if geopolitical tensions ease, particularly in the Middle East, you could see the dollar push back toward the 100-101 range. When that happens, metals often face pressure, not because the fundamentals disappear, but because the currency they are priced in gets stronger. Think of it like measuring something with a different ruler. The object did not change, the measurement did. And this is where speculation comes in, because a lot of the recent move in silver has had a speculative component tied to geopolitical risk. If that risk cools, some of that positioning can unwind quickly. If you know someone who has been watching silver this week and trying to make sense of these moves, share this video with them right now, because this is exactly the kind of situation where people get pulled into one narrative without seeing the full picture. Now let's come back to the physical side, because this is where the Shanghai premium really matters. The Shanghai Gold Exchange data shows that premiums have moved above 5%, and historically, when you see sustained premiums at that level, it indicates strong local demand relative to available supply. But in this is critical, premiums can reflect more than just scarcity, they can reflect financing costs, local currency conditions, even regulatory factors. So before you run with the idea that silver is running out, it is more accurate to say that demand in that market is strong enough to support higher prices relative to COMEX at this moment. And here is the part that experienced traders watch. Does that premium persist, or does it collapse? Because persistence is what drives behavior. If that 5% plus gap stays in place, it creates what traders call a vacuum effect, where metal starts flowing toward the higher priced market, and that flow can eventually force prices on the lower side to adjust upward to close the gap. But if the premium fades quickly, then what you saw was a temporary dislocation, not a structural shift. Think of it like water finding its level between two connected tanks. If one side is consistently higher, water flows until they balance, but if the height difference disappears, the flow stops. So what does that mean for you? It means the premium itself is not the signal, the persistence of the premium is the signal. Now, if you have stayed with me this far, this is where it actually gets more interesting, because we have to layer in the macro picture. Central banks have been consistent buyers of gold over the past few years. The World Gold Council has documented this trend clearly in their recent reports, and while silver does not get the same official sector attention, it is still tied into the broader precious metals complex. These are not traders chasing short-term moves. When a central bank reallocates reserves, that is a multi-year decision. On the currency side, when I looked at the latest US fiscal projections and treasury data, the math is not breaking overnight. But it is getting tighter. I am not saying the dollar collapses next Tuesday. What I am saying is the structural pressure is building slowly, and that is part of why metals remain relevant in portfolios. And for UK viewers, this is where the Bank of England and LBMA data come into play. London remains one of the central hubs for global bullion flows, and when you see activity shifting between London, New York, and Shanghai, you are looking at a global system adjusting, not a single market anomaly. De-dollarization is a decade-long process. It is not a Tuesday event. But the direction of travel is visible if you are looking at the right data. Now layer in industrial demand, because silver is not just a monetary metal. When I pulled up the latest Silver Institute data, the trend is clear. Demand tied to solar, electronics, and emerging technologies continues to grow. I am not going to give you a precise ounce per megawatt number, because that would be false precision and you deserve better than that. But the direction is what matters. Silver is embedded in systems that are expanding EV infrastructure, 5 grams networks, AI hardware, and unlike gold, it is often used in ways that are not fully recoverable. Think of it like tiny amounts of metal spread across millions of devices. You do not get all of that back. So the pressure is not explosive, it is cumulative. Alright, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. The paper lane futures positioning margins right now is showing elevated delivery activity in a market that is still trying to price in both macro uncertainty and physical signals, and the CME data this week reflects that tension clearly. The physical lane premiums, inventory, real metal movement is where the Shanghai premium stands out, because a sustained 5% plus premium is not normal in a balanced market, and that is coming directly from Shanghai Gold Exchange pricing data. The macro lane rates, dollar geopolitics is still mixed, with the dollar stabilizing but fiscal pressures and global shifts continuing in the background, as reflected in recent Treasury and World Gold Council data. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today, I am saying it is worth knowing what to watch for when the paper lane is showing stress, the physical lane is showing demand, and macro is leaning supportive. The historical pattern has often been upward pressure on price, but that is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing, I will tell you exactly what I am looking for and exactly why, and next video the first thing we do is come back to this. I am watching whether the Shanghai premium stays above 5% through the next set of trading sessions, using Shanghai Gold Exchange data as the source. If it holds above that level, it suggests sustained demand and increases the likelihood of continued pressure on Western inventories. If it drops back below that level, it tells you. This may have been a temporary dislocation rather than a structural shift. This is my one call for the week, John FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. For the more optimistic picture to develop, you need to see that Shanghai premium persist, COMEX inventories continue to tighten, and macro conditions remain at least neutral to supportive. That combination creates upward pressure over time. On the other hand, if the dollar strengthens, geopolitical tensions ease, and that premium collapses back toward normal levels, then the current setup can unwind quickly, and prices can stall or pull back without anything breaking structurally. Both are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First, are you holding physical silver right now, or are you primarily exposed through ETFs or mining stocks? Second, based on what we walked through today, do you think this Shanghai premium is more likely to persist or fade over the next week? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe, because next week we are going into COMEX inventory mechanics in detail, and I will show you exactly how to read the warehouse reports. That is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.